Hinduja Global Solutions, a company that destructed their public shareholder value by using their fair share of money that came from the sale of their healthcare business for giving out loans to their related parties. You're watching Radical Governance, and this is Radhika Bajoria, founder Radically Yours. Hinduja Global Solutions had recently in January this year sold their healthcare business to Baring Private Equity Asia for $1.2 billion. With this, the company had net cash of around rupees 3,500 crores, investment in debt of around rupees 2,400 crores, and had deployed the rest of the cash for the extension of ICDs, also known as intercorporate deposits, to related parties of around rupees 1,124 crores from the sale proceeds. What is noteworthy here is the extension of unsecured loans to related parties and not sharing the sale proceeds as dividends with their shareholders for the longest time. This value destructive move by Hinduja Global Solutions only benefits the borrower, which is the promoter here, leaving the public shareholders out in the cold. In this video, we have discussed this governance issue at length with proxy advisors who had represented and advised the shareholders of the Hinduja Group, shareholder activists, and other governance educationalists. Hinduja Global Solutions had, taken the sale proceeds from the business, the healthcare business that they got, and instead of giving it out as dividends, they rather chose to extend the loans to their promoter entities. And now we're talking about unsecured loans. So what is your first instinct on this when you see this happening from a governance perspective?
Yes, all investors expected that Hinduja Global Solutions, once it has sold the healthcare business to Baring, it would use the proceeds to pay a special dividend to investors, or use the proceeds for growth of its own business, or use the proceeds to acquire some other business. And neither of these three have happened. And as the fears of many of the investors were, a bulk of the transaction proceed is likely to be used to give out loans as intercorporate deposit to related parties or the promoter entities. So which defeats the purpose of why the business was sold and wealth creation for the shareholders of Hinduja Global Services itself. HGS has been traded at very low PE multiples, has not had large institutional investor holding, etc. I don't think the Hindujas rate high on corporate governance as a group itself, and this is one more example of how the promoter's mindset is more to sort of shortchange the minority shareholders at the expense of the company and the minority shareholders. The promoters benefit.
Ideally, what we'd like to see is that companies who get significant sums of money from sale of business, need to be clear about what they're going to do, and ideally these need to be distributed to shareholders. They got about $1.1 billion, which is quite significant. It should have been around 8.89 thousand crores. Now that's a lot of money. Now it hasn't gone to shareholders. Even as we are thinking about expansion, we're going to give the money to some of the group companies as unsecured loans.
So is it really compulsory to give the dividend proceeds out of a sale, or the company can choose to keep it with themselves to grow the business further, and then later on, of course, distribute the dividend after generating more business in the company?
Piramal sold its business to Abbott, and overnight they got huge funds, and then they did not give a special dividend, but they used it to grow their fintech finance businesses and real estate businesses, and that has sort of probably helped their shareholders, giving unsecured loans at very low interest rates to related parties. And at the end of the day, this is detrimental to the interests of shareholders of HGS.
Even if a loan was given, why was it unsecured and at an interest rate of just about 7%, which is much lesser than the market rate of 16%? What if it defaults because it's unsecured? The public shareholders will have to suffer for something that they didn't even agree to, because in the shareholder resolution, 78% shareholders were against the increase in the limit of loans that the company can extend to other promoter entities, as they were rather expecting good dividends from such a huge sale of Hinduja's healthcare business.
How compulsory is it to borrow at the same price that they would have from unrelated parties?
Further, let's assume it's the same rate at which they can borrow. But this is not the business of the company, right? If they have to, or they owe it to their shareholders to kind of put it in the most secure way, to kind of take a hard decision, have a difficult conversation with their bosses to try and recover the money. Just not going to happen given where we are and given what our culture is. You've sold a business which is accounting for roughly half your top line. What you're telling the market is, hey, don't worry, we're going to continue to see the same growth. And that is a bit surprising given the fact that they've said, hey, we're going to be lending money. From a shareholder perspective, these are all red flags which kind of keep popping up.
The main business of HGS is not giving out loans, be it either to related parties or promoter entities or anyone else for that matter. If they have capital and they are not in a position to use it for their own business growth or for acquiring any company, they should return capital back to the shareholders. Business of the company is not to lend money to anybody, to the promoter entity. And it is only all the more galling that such a huge amount of money, markup itself, is going to be given as loans to promoter entities.
Well, the result of such bad corporate governance in turn showed up when the shareholders sold their shares in the market and the share price was down by 20%. In such cases, the board, especially the independent directors, must be cognizant of their role to protect the interest of minority shareholders and return the excess funds as dividends instead of just letting promoters take public money home for their own private interests.
So that's about promoters. When we come to the directors on the board, what are their duties?
Promoters do take decisions, they kind of overreach themselves, they do things which ideally they should not be doing, and therefore it's the role of the independent directors to draw a hard red line for the promoters and say that this is where you get off.
The independent directors don't seem to have a mind of their own, and they are just endorsing what the promoters are saying. So at the end of the day, as is seen in many other corporates in India, the independent directors are just towing the line of the promoters. So they are just sitting on the board seats, warming the chairs and eating cashew nuts and in board meetings and just going home, I guess, and collecting their sitting fees.
What is it that we can do to protect the interests of the shareholders?
Shareholders have to continue to voice their disapproval by voting. So therefore, you have to hope that there are going to be checks and balances which people bring upon themselves. Behave this way and shortchange your shareholders. Market is kind of listening to what's going on. They're seeing what's going on. You can be pretty sure that they're also going to be a little bit reluctant to say that, okay, we are signing out the next check for you. What happens is that you've got a set of controlling shareholders who kind of use their influence or shareholding to push through certain deeds or acts which benefit them at the expense of the others.
Everything here is sort of, though, from a perspective of legal, I would say, compliance. So SEBI's arms would be tied in that sense because it is within the ambit of all the regulations that SEBI has put out. Investors need to be complaining, writing, and shunning the stock.
Can we have a scope where we have a body or an association that looks after the shareholder interest?
Dumping the shares is one. Two is obviously being more activist, being in that sense of writing to companies, writing to directors, naming and shaming directors, and sort of writing media articles, complaining to the regulator, etc., and trying to get an outcome which they want.